in normal retracement scenarios, 50 to 62% is typically where markets find their bottom. Now, not always, but that is usually where we start to see markets try to fish for a bottom, at least find some basic support. Here's what you need to know before the bell this morning. So news alert out this morning, very early. You can't read this, but this is this big red bar across the top up here. This, markets have started to really take notice of what's happening, and we're starting to see some actions being taken. The Thai Stock Exchange has banned short selling from the 8th to 11. We're starting to see markets now responding to this. Now, we haven't seen that here yet, but markets are beginning to get worried about the magnitude of these sell-offs. And don't forget, there are circuit breakers in place. So if the market drops too much in one day, we just shut down the markets, and that's happened before. We haven't got there yet, but those are also in place. Secondly, is that the markets are very, very oversold on multiple levels. So again, and this is something I'll get into a little bit more this morning, this is that Fibonacci retracement sequence that we talked about on Friday. We're currently sitting at about that 50% retracement. That's where we closed on Friday. This morning, we're going to challenge the 62% retracement, which takes us back to these lows that we had last May in the markets. And again, this was during that initial kind of sell-off early last year before we got into the yen carry trade blow up in July, August, but we're getting back to that support level. That's that 62.8% retracement. Now, in normal retracement scenarios, 50 to 62% is typically where markets find their bottom. Now, not always, but that is usually where we start to see markets try to fish for a bottom, at least find some basic support. Markets are very oversold on the relative strength basis, very oversold on the momentum basis as well. Not surprising after last week, obviously. But again, we're kind of at levels now where markets have really been kind of pushing more of the extremes. One thing that's been working well, of course, last week in particular were bonds. Bonds are now very, very overbought. So if you're long bonds and you're looking to take some profits, this is actually not a bad time to do it. Bonds actually broke above the 200-day moving average last week, bullish there. We're starting to get moving averages turning up, suggesting lower yields in the future. But on a short-term basis, we're pretty overbought here. So again, might want to think about taking some profits out of bonds, because if you're just trading bonds, again, if you're holding bonds, that's fine. You don't need to do anything. But if you're trading bonds in your portfolio, I would look to take some profits here and then probably start buying stocks. We're going to get a bounce in stocks, and when stocks bounce, we'll get that reversal of that risk-off trade we saw last week. Money going out of stocks into bonds. We'll see that reverse. People pull money out of bonds to go back into equities, at least for the dip. So, so that's kind of the setup here. So be a little bit cautious. Again, just kind of how how you approach this. Whatever rally we get is likely going to be short-lived. Could see a fairly decent rally because of the magnitude of the decline. But whatever rally we get, we're going to get a retracement, most likely retest these lows before you set the final bottom. That would be a normal kind of setup for the markets to kind of form a bottom. But again, it doesn't have to happen that way. Back in 2020, Fed stepped in, markets went straight back up. But the Fed's not stepping in right now. There's no expectation the Fed is going to step in right now. So we see a rally. A lot of trap longs want to come back out. You get another decline. And that's potentially the bottom that you buy. Fed's expected to start cutting rates in May. They're cut 5 times this year, so that's going to help ease some of the downdraft on the markets. But one of the things we'll have to contend with as we get further into the year is the impact of these tariffs on the economy. If we start getting into recessionary territory in terms of the economic data, which we're not there yet, and the employment report on Friday, decently strong, no real sign of recession, but that's very much lagging data. If we start seeing more recessionary pressure later this year because of tariffs, yields obviously go lower. Stocks are going to remain under pressure. And as we kind of laid out at the beginning of this year, we really didn't expect markets to do much this year. Didn't expect this, but don't expect markets to be, really any higher than we probably started the year at this point. So again, a recovery, another decline later this summer, recovery into the end of the year, kind of wind up about where we are, maybe a little bit better. But that's probably the best we're going to expect this year based on where tariffs are. Now, if things change and we see a reprieve of these tariffs or a reversal for whatever reason through negotiations, whatever it is, then very different environment setup. So we'll have to just kind of work our way through this. But right now, at least looking for today, I would be looking that this market tries to hold the 62.8% retracement level, maybe even get some recovery during the day. I think we're going to start seeing some buying kind of step in here. We're just pushing a lot of extremes, but that's what you need to know before the bell this morning.